Bitcoin feels like it is breaking down, but the chain is showing something more specific. This may not be the end of the bottom zone. It may be the beginning of the bottom clock. That is the conflict in this video. The market feels impatient. People want one clean bottom, one clean bounce, and one clean answer. But on-chain bottoms usually do not work like a light switch. They look more like a pressure chamber. First, holders go underwater. Then, older coins may finally move. Then, miner revenue stress either confirms the washout or refuses to confirm it. Start with supply and profit and supply and loss. The principle is simple. Supply and profit measures the percentage of Bitcoin whose last move price is below the current price. Supply and loss is the other side of the same coin. If profit is 49%, loss is roughly 51%. Together they always add up to 100%. Why does that matter? Because when these two lines cross, the market psychology changes. More coins are underwater than comfortable. The room gets heavier. This is not automatically the final bottom, but historically, it has marked the entrance into a bottom formation zone. Look at the chart. In the 2018 cycle, the crossover started on the 14th of November of 2018, and the market stayed in that zone through the 4th of March of 2019. That was 110 days. In the last cycle, the crossover started on the 18th of June 2022 and stayed in that bottom zone map through the 1st of January 2023. That was 197 days. Now look at today. This cycle crossed on June 4th, 2026. The latest reading shows supply and profit near 49% and supply and loss near 51%. In plain market terms, slightly more supply is now sitting underwater than in profit. If this cycle behaved like 2018, the exit window would point around the 22nd of September 2026. If it behaved like 2022, it would point around the 18th of December 2026. The average of those two historical windows is about 154 days, which points around the 5th of November 2026. That is not a prediction, it is a calendar map. It says the bottom zone can be real, while still needing time. And that is the part most people do not want to hear. Now move to VDD Multiple. VDD stands for Value Days Destroyed. The basic idea is this. When old coins move, they carry more weight than young coins. A coin that has been sitting for years and suddenly moves says more about long-term holder behavior than a coin that moved yesterday. So VDD is not just another oscillator. It is a stress signal for old, patient supply. Low VDD means old coins are mostly quiet. A sudden lift from low levels can mean that some of the most patient holders are finally moving coins. In bottom zones, that can line up with emotional exhaustion. The latest VDD multiple is around 0.38. Earlier this year, in March, it reached about 0.246. That is already a cold zone reading. It is close to the historical bottom neighborhood, especially compared with the 2018 cycle low around 0.2 and the 2022 cycle low around 0.247. But here's the important twist. Historical price lows did not always happen at the quietest VDD point. Around the 2018 bottom, VDD lifted sharply as older coins moved. In November 2022, the same kind of behavior appeared again. Old coin movement rose during the stress window. That is why I would not treat the March VDD low as proof that the final bottom is done. The more uncomfortable possibility is this. The final low may arrive when VDD suddenly lifts from the cold zone, because that would show old holders finally reacting under pressure. This is the patience part. If you are managing risk, history argues against chasing every bounce as if the bottom has already been fully cleared. For anyone who already has a plan, the more conservative behavior is gradual exposure, dry powder, and predefined risk limits. Historical patterns are references, not laws. This signal can fail. A clean repeat is never guaranteed. Now the third chart. Puell Multiple. This one is about miners. It compares current miner revenue to its longer-term average. In simple terms, it asks whether miners are being paid unusually well or unusually poorly. When Puell gets very low, miners are under revenue stress. Historically, deep bottoms often came when Puell moved near or below its lower bottom band, the mean minus 0.85 standard deviation line. Right now, Puell Multiple is around 0.785. The current lower band is around 0.379. So yes, miner revenue stress has cooled down a lot, and the market is far from overheated. But Puell is still above the deepest historical bottom stress line. That creates the same message as the first two charts. Supply says the bottom clock has started. VDD says old coins are cold, but the final stress lift may not have arrived yet. Puell says miners are stressed, but not at the deepest historical washout line. So here is my overall view. The market feels like panic, but the data says something more precise. Bitcoin is in a bottom formation zone, not necessarily at the clean exit from that zone. The shareable judgment is this. The bottom zone may be real, but the exit may still require time, old coin stress, and confirmation from miners. Treat history as a map, not a promise. This is not financial advice. Manage position size, keep risk under control, and never assume that one historical pattern has to repeat perfectly.